I don't think we've seen a period of so many of these different industries being disrupted all at once like we are right now.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. We've got a great show today. I am joined by Greg Martin, founder of Liquid Stock and founder of Archer Venture Capital. Greg has had a long career in VC, and we're going to talk about venture capital. Greg's company, Liquid Stock. We'll talk about accessing alternative investments and illiquid asset classes. We're going to talk startups, fintech, and more. Greg, thank you for joining the show.
My pleasure. Thank you for having me, Phil.
All right, so I thought it'd be helpful if you did a quick run through of your background, really how you got started in VC, and then some of your career leading up to what you've been doing lately at Liquid Stock.
Sure. Growing up, my father was an entrepreneur, and I was always doing entrepreneurial things from an early age. I started out with a used golf ball business where I contracted with local golf courses, and I dove into their lakes and rivers and found used golf balls and sold them to financial services people. It paid for a lot of my early life, and it sort of really gave me the entrepreneurial bug. In college, I had a custom-made suit business where I would contract with a major manufacturer of suits, and I would provide people in college with very heavily discounted ability to have their own suits at an affordable price. And really, for the manufacturer, it was a way of getting brand relationships early on with people. And, I was a finance, accounting, and information technology major. So I looked to do tech-related things. And I was actually, when I came out to Los Angeles to go to business school at UCLA, I was actually starting a business, a direct from grower to consumer flower business, an internet flower business in the late 90s. And in that process, I was actually working with a VC who we started talking about some of the issues I was facing. And we kind of looked at my background, and I started to understand the venture capital world in this process. And he ultimately talked me into becoming a venture capitalist, just given my entrepreneurial background, my interest in entrepreneurship, but also the finance and accounting and technology background that I had. And given that I had a little bit of ADD, probably being able to have a portfolio of companies to work with, as opposed to just focusing on one as an entrepreneur, is probably why venture capital resonated with me. And so that's really how I got into venture capital.
So a couple really interesting things that you've said, and some threads that I see over and over. The role of the VC is very different than the role of the founder. Yet, very often people are attracted to VC because they've gone through the startup, because they are a founder, and they tend to go. I've seen people go kind of back and forth between the two, even though the roles are very different. And another thing that jumps out at me that you said is that you had ADD. I too have pretty severe ADHD, made me a horrible student in school, but I think a pretty good, in some ways, founder, or now, co-founder. And it's a very different skill set. Is that something that you've seen with the companies, the portfolio companies that you've worked with, and the startups that you've done, that those are common threads?
Yeah, I would say so. I mean, obviously there's times in life when you really do need to focus on one thing. But I think, the ability to compartmentalize and to be able to manage a lot of different, whether it's companies or customers or your personal life with your professional life, I think people with ADD, interestingly, are actually quite good at compartmentalizing things. Sometimes they're not so good at focusing just on one task. Being an entrepreneur or a VC requires you to be able to handle lots of different tasks and potentially have a lot of chaos. And so I sometimes get frustrated if I'm just doing one thing, the same thing over and over again. But when I'm kind of exposing myself to a variety of things, and I'm very capable of multitasking from one thing to the next, but I have a hard time sometimes just sort of focusing on one thing, which I think is common with people who have ADD. And so I have a personal need to feed myself with that variety of tasks or activities, and it lends itself well to being a venture capitalist, or even an entrepreneur, when you have to wear a lot of different hats. When you're an entrepreneur, you have to be a leader, you have to be a salesperson, you have to know finance, you have to understand HR. There's a lot of different things that are kind of coming at you And I'm not sure why I'm able to do that, but I do think that people with ADD in some ways are actually more adept at handling that, whereas they're not as good at just focusing on one thing.
Right. And then you get into these periods as a startup founder where you have to go into deep concentration and have this like myopic focus on the end game. And it's such an amazing contrast. So for me, like right now, I'm in one of those states where I'm like, deep in hibernation and thinking through and working through a particular problem. So I've got this podcast as my outlet to talk to people like you and to talk to, interesting people and see what's going on. And to that point, what really drew me to your story was the liquid stock company. I mean, it's just such a great idea. So tell us what it is from a high level, and then what was the aha moment that really came to you where you realized that this was something that had to be out there.
Right. So at a high level, liquid stock is a fund that we formed where we help employees or shareholders of private technology companies. We help them use their illiquid options or shareholdings for liquidity. And one of our primary use cases is helping employees exercise their options. Employees are sitting on sometimes millions of dollars worth of options that are basically on a Word document that they received when they first came into the company. And they often don't have the cash to cover the exercise price, and certainly don't have the cash to cover the taxes that are often associated with exercising their options. And so we provide financing for those employees to be able to now own their shares, as opposed to just looking at a Word document that has their shares. And for them, there's a few benefits. One of the benefits is the peace of mind of now owning your shares. In many cases, a very high percentage of your net worth is tied up in this piece of paper that you don't actually own. You're entitled to it, but only if you come up with the capital to actually exercise. And two, there's a real tax advantage to owning your shares earlier, because there's a short-term capital gains rate and a long-term capital gains rate. And when it comes time to sell your shares, if you've held your shares for more than a year, meaning you would have had to have exercised them more than a year ago, the difference between long-term capital gains and short-term capital gains can be as high as 20%. So there's a lot of money being left on the table by not exercising those shares sooner. And so we provide those employees with capital and financing, and we do it in a very high peace of mind way. We use only the shares they have or exercise as collateral. And so they're not putting any of their own personal assets or their own cash at risk. So if for some reason the shares end up being worthless, they don't owe us anything. They just have to hand over the worthless shares, and they've satisfied their obligation. And so it's a very low stress way for employees to be able to exercise and own their options. The other thing that our product does is we enable you, to the extent to which there is incremental value in the shares that you own, we enable you to use those shares for liquidity. Even if you own the shares, even if you've already exercised and own them, or if you invested in the shares, oftentimes you may have to wait many years before those shares can provide you with liquidity or cash, to buy a house, to pay for private school, whatever it might be. And so we enable you to use those shares almost like an ATM machine, or like think of like using your house to take out a home equity loan. We enable you to use those shares for liquidity. And so the financing product works the same way. It's just a different use case. And again, it's recourse, meaning the only thing you're putting at risk is the value of the shares. You're not putting any of your personal assets to at risk. And so, a lot of people find that to be a great way to get liquidity for their illiquid stock, and hence the name liquid stock.
Right, which is on point. And I love this product because, you're clearly, I mean, as you said, there is clearly a case, there is clearly a problem being solved. You have somebody that, was let's say a founder, an early employee at a tech company that's doing really well. They've got a high valuation. You've got three problems. You've got a huge tax liability. You've got massive concentration risk. I mean, we just saw that play out with WeWork, and you have no liquidity. And, life happens, and maybe you need money today, and, you just don't have access to it. So you're solving three problems. There are other solutions or other programs out in the market, secondary market platforms for private shares. How does liquid stock differentiate from those?
Yeah. So, I mean, if you think about a secondary market platform, these are sort of trading markets. One of the first was a company called Second Market, and there's Nasdaq Private Markets, and there's all kinds of broker platforms that enable holders of private shares to sell their shares to investors that want access to these private shares before these companies go public. And so these secondary market platforms have arisen to solve that problem. But in that case, you're selling your share, right? So if you believe in the upside of the company, well, the last thing you want to do is sell your shares, but you want liquidity. And so if your shares is the only asset you really have, that's what you have to do to sell your shares. And of course, that assumes that there is demand for your shares in the first place. Many companies actually make it very difficult for their employees or investors to sell via these secondary market platforms. But to the extent to which they do, you are selling your shares and you're losing all of the future value in those shares. And that may not be the best solution for you. With our product, you don't sell your shares. You use your shares for liquidity or financing to, buy your house or, pay for private school, whatever it might be, but you still own your shares. And as the shares go up in value, eventually when there is liquidity, an IPO or a sale of the company, you then owe us, the money you borrowed back plus our cost of capital, but you can pay us in any form and you haven't lost the upside in the shares that you would have otherwise sold through the secondary market platforms. So we're a great solution for people who believe the value of their shares is going to go up. If you don't think the value of your shares are going to go up, then in that case, you're probably better off, if the option exists to you, to sell via the secondary market platform. So anyone who thinks the value of their shares going up should be looking at working with liquid stock versus selling their shares on a secondary market platform.
Yeah, no, that makes sense. And there's, there's also there's a trend out there with income sharing agreements, and the idea is, it's just so interesting to me because I'm at that stage in life. I'm about 40 years old, right at that curve where people start going from red to black, generally speaking, and you have think of somebody who graduates med school or even law school, right? And they've got tremendous debt and they've got tremendous future earnings power, and all of us really, if our savings account do what they're supposed to do in the future, then, our future earnings are much higher than our present. A lot of people who are starting young families, they have a need for spending early in their career and then later in their careers where they really start to accumulate wealth. So any solution that can help flatten that curve and help people really, spend when they need it or have that liquidity is something that, really solves a very real and tangible problem.
Absolutely. And that's really what we're doing. I mean, you're sitting on these illiquid shares. You have needs for money today, right? All the ones I mentioned, and there's millions more. And so, it's difficult to remain patient. These companies stay private longer. And so we're basically advancing you money based on our belief of the future value of the shares. So we share the same belief and we're willing to, take a chance and invest in the value of your shares in much the same way that these income sharing things are doing, where they're in many cases maybe financing your education, and then they only make money if the education results in an income, and the more you make, the more the lender makes. Same with us. We're advancing you money in the belief that the shares will have future value. And if the shares don't have any future value, well, then we're out our cash and you have not taken any personal risk. But if the shares do have more value, which we're all aligned to cheer for, then it's a win-win. We make more, you make more, and of course, you've solved your near-term liquidity problem today. And so we're really creating a win-win situation for our counterparties and for us, and that's why we've had a lot of interest in what we're doing.
So, then that was going to be my next question about counterparties. Who is the counterparty?
Yeah, so at the core, the counterparty is an individual or institution who either owns options or shares, which basically this illiquid security, right, that they would like financing for. Sometimes they want financing to exercise, sometimes they want financing just for liquidity. So at the core, that is our counterparty who we're actually entering into a private financing agreement with. And then they're utilizing only the shares that they own as collateral for this financing. Now, if you think about it, though, our real counterparty is the company, because we're advancing the capital not against the value of the person, but at the value of the shares that they own. And so we're really, think of the private shares as like a house. So we're advancing money based on the value of the shares, just like a bank is, lending money against the value of the house. And so we're really thinking about what will those shares be worth in the future and how much are we willing to advance today against those shares. So it's incredibly important for us to value the underlying company itself and make sure that what we have is a core security that has good value today and good value in the future. And obviously, we do care about the quality of the counterparty because we are entering into ultimately a financing contract with them. So there's a need to be trustworthy and things of that nature because ultimately there is a direct relationship with them. But more important is the value of the shares.
So how do you do that valuation? Do you perform a valuation on every private company? And what happens in a situation where you think a company is overvalued? Do you just decline to finance against those shares?
Excellent question. So yes, we certainly do underwrite or value the company itself independently. And obviously there's data points in the marketplace. We know that, the company has traded at X and, the last round valuation was Y, and of course we're able to gather our own financial information to make our own valuations, not only today, but what it's going to be in the future. And certainly we're not going to invest in companies who we think maybe has valuations that are unstable. Maybe there's a risk that it goes under or goes down significantly. We certainly are focused more on companies that we think will not only be stable, but will grow. And we've done deals in companies like Uber and Airbnb and Epic Games and other big companies. We're very focused on those types of companies and companies that we think, and not all just of the big name ilk like those guys, but companies that we think are going to be around and be successful and grow their valuations. But the valuation work is incredibly important, and it's one of the big proprietary capabilities of liquid stock.
One of the things that I'm endlessly fascinated about is the difference between how equity valuations are done in the public markets, which is where I grew up, versus in the private markets. And I ran an ETF for a while that was based on the idea of intangible assets. And it's just amazing to me that in the private world, it's like, well, okay, the company's worth X, but we're just going to, add, we're going to triple the valuation based on intangibles. It's got a great brand and some customer loyalty. And ultimately, I've joked that in the VC, there's no value investors in the VC world, right? It's all just, top line growth. And, in the equity markets today, there's no value investors in the equity markets either. But in most cases, in most of our history of public markets, there is a real component of value investing and intrinsic value and what's the company actually worth. But even today, like the difference between valuing a pre-IPO high-growth Silicon Valley company and the difference between valuing Coca-Cola by a Wall Street analyst, it's like a totally different language.
Totally different. I mean, take a great example like Snowflake that just went public. It's trading at something like 100 to 120 times forward revenue. How do you justify that, right? Fortunately, I grew up as a Series A venture capitalist, and so I'm used to really thinking about the product, the management team, and the market opportunity. And when you're a venture capitalist, you're really thinking about, well, if things go right, what can this company do from a revenue and EBITDA perspective? Sometimes 10 years, 20 years out, right? I mean, you're really thinking about things, in the out years. I mean, if you look at Snowflake, like in order to justify that valuation, you really have to be thinking 5-10 years out. What can they be? And so a lot of the valuations are basically based on the addressable market. Obviously you can look at the current growth rates, but it's in order to truly justify those valuations and start actually doing DCFs that don't result in crazy formulas on your page, you really have to think about 5-10 years out. And so, we really do have to look towards the future when you're evaluating these high growth companies and, obviously market opportunity, growth rates, competitive advantages, quality of product. Those are things you focus on more than current financial metrics. A lot of, value investing is based on just running the models. They're very tight. The numbers are there. There's a lot of history, and you can kind of tweak, earnings growth and expense growth. But with these kind of high growth companies that don't make any money yet, most of these companies are, losing a ton of money. You got to apply a whole different lens to them. And of course, these companies in the private markets, it's even harder because they're run differently. They're not focused on hitting quarterly numbers when they're a private company. They're focused on adding products, growing products, growth, really very little concern about profitability, and increasingly so because it used to be that, there was a limited amount of private capital in the past. And in order to access the really large amount of dollars, you had to go public, right? And that kind of changed in the early 2000s period as, going public became harder and harder. We had Sarbanes-Oxley, we had consolidation of investment banks. So the old boutique investment banks were no longer in the system. And so you really had to be a much bigger company to go private. And then these companies were staying private longer. And, they started to grow well in the private markets. And then all of a sudden, a lot of these former public investors and sovereign wealth funds and people from all over the world started to see that all of the growth is now happening in the private markets, not the public markets. So all of these private investors started pouring money into these private companies. So now these companies would stay private even longer, because why go public when there's plenty of capital to access? You don't have to answer, every quarter to a public market investor. You don't have to disclose what you're doing. You don't have to worry about that day-to-day grind of being a public company. And there's plenty of access to private capital. And of course, the final issue was liquidity, right? Is one of the reasons companies went public was to become liquid. And, you saw the rise of the secondary markets, which enabled people to get early liquidity. So these companies could continue to stay private longer, which, by the way, all plays into what we do, because the more companies are staying private, the more these liquidity issues continue to be issues. And there's a greater need for us as an alternative source of liquidity. And so that's a long-winded way of kind of highlighting the difference between a private and public company. And of course, now that's why you see, by the time a company goes public, now they're worth 10 plus billion. And they've been private for, a lot longer than they ever would have been, and had the public markets been open to them, and had they been choked off from capital, which is now no longer an issue.
Right. But sometimes it works against them in that, you give somebody enough rope. I guess I'd compare it to giving my kids too much sugar for breakfast, right? Like, because let's look at WeWork. I mean, did you have any WeWork exposure?
Yeah, so WeWork's a great example. And, obviously that you had some major corporate governance issues at WeWork. You had a, incredibly magnetic entrepreneur who could tell a story like nobody else. And obviously the company grew, and they had this tech-enabled label when really they're just, taking out long-term leases and leasing them out on a short-term basis. And yet they're getting a tech multiple for that. I mean, that used to be called being a landlord. And, that business should have been valued much more on cash flows, but for some reason they were getting a massive revenue multiple. And I think, and it starts to become a greater fool theory. People are like, oh, well, X firm is invested and they're paying this. And so then, SoftBank comes in and now it's worth $48 billion. But sometimes these companies, they get to the public markets, and the public market looks through the S1 and, sees some of the corporate governance issues and starts to actually question, what we just discussed is, are they really a tech company, or are they just a landlord who has maybe a flawed business model, taking out long-term leases and only, leasing out on short-term basis? And oh, by the way, what happens when there's a recession and you have a long-term lease and you have a bunch of short-term tenants? That was our problem. We looked at WeWork. We, had an opportunity to do a lot of WeWork deals, and we just couldn't buy into the valuation for sure to begin with. But even the business model, as I said, had challenges. And you can only imagine if you're stuck with long-term leases and no one's using your office anymore, you're going to lose all your customers. So WeWork's probably sitting there today with massive long-term leases that they got to pay for, and all of their tenants are probably working from home, and they've probably shut off their month-to-month deals. So everything we were worried about with WeWork has, started happening, but has been probably accelerating, I would assume, under COVID.
It's unbelievable because, I mean, it's hard to remember, January and December was about like 20 years ago, at least if you're counting by the growth of gray hairs on my face. And all this WeWork stuff happened before, completely separate of and before COVID, completely unrelated. And to be hit with a double whammy like that, I'm amazed they're still standing. And, God bless them, and I hope they survive. But I'm amazed,
And I agree. And what they do is actually really good, by the way. And actually, I think that a lot of companies will now not lease long term, and they will get into WeWorks. So there will be a little bit of clawback, and they do a great job. And many of my companies are actually getting out of their long term leases, and they're just using WeWork, and they're like, hey, we don't need 50,000 square feet anymore, but we would like to have a place for our employees to gather and have meetings. So why don't we rent out 5,000 square feet at a WeWork, which we can get out of on a moment's notice, or we can add if we need to add. And so, I think WeWork will benefit, as well from some of that, but just their fundamental business model was flawed.
And there's a whole nother issue that very few people are talking about, which is the shrinking pool of U.S. listed public stocks. There are fewer and fewer. We're down to like 3,300. The Wilshire 5,000, a lot of people don't realize, you assume it's got 5,000 stocks. The Wilshire 5,000 is down to like 3,500 stocks, or 3,300, I think it is. It's getting smaller and smaller. And not only is it getting smaller and smaller, the pool itself is getting more and more concentrated. So you've got institutional investors that are looking to diversify their holdings and diversify their companies, and there's really no way to do so without, going into 2 and 20 fee structure LPs, and this could potentially be a solution for them. Is that one of the ways that you look at it?
Absolutely, and we have a chart that kind of shows the increasing number of private companies and the relatively stagnant growth of exits. Right, so what's really happening is there's just more and more private companies that are staying private longer, as you pointed out, and not going public. And the exits are still fairly flat. And so, in order to access growth in our economy, you have to come into the private markets. And so, one of the things that the biggest issue, of course, is when you're in a private company is liquidity, as you point out. And if these companies are staying private longer and there's more of them, and the exits to get into, the public markets or the M&A markets is stagnant, we're going to be a great source of liquidity for a lot of people. And obviously there's secondary market platforms, and I told you that there's pluses and minuses with those. But if you believe in the growth opportunity in your business, but you want liquidity today, that's what Liquid Stock is here for. And we hope that many people will reach out to us and we can solve their liquidity problems.
So you've been involved in fintech, certainly in venture capital for quite a while. What are you seeing from more of a macro point of view in terms of the trends, in terms of where the puck is going?
There's a real transformation happening. I mean, there's the fintech companies themselves, right? I mean, there's companies like Stripe and Robinhood and Chime and Betterment, and there's a lot of rapid. There's a lot of innovation happening in fintech itself, right? And then there's and a lot of it's sort of digital, and it's like frictionless. And of course, you have obviously cryptocurrencies, et cetera. It's cutting out all the costs. It's leveraging mobile technology. It's leveraging blockchain. It's leveraging technology to reduce friction and to make things happen more seamlessly and for lower costs. I mean, there's a lot of spread in financial transactions, and a lot of that's going away. So that's just on the fintech company side. And it's very interesting. I mean, Chime has grown to a $15 billion valuation in a very short period of time, just as an alternative banking solution for people who make $30,000 to $70,000 a year. Robinhood has grown to a very big valuation. It's really just a brokerage, but it's zero cost transactional brokerage, and it's very, very simple, a great mobile app. And some of these things, you almost shake your head. It's not like it's rocket science what they're doing, but they just do it really well, and they leverage today's technology, and they're not encumbered by legacy business models or legacy technology. And that's what we're seeing. And of course, there's companies like Stripe that are worth, $36 to $50 billion right now and still private, that are really just a new payment system for the emerging, e-commerce world that we have, kind of replacing some of the older, more expensive, less technically sophisticated, less, transparent, less, speedy transactional systems that we had. And so, there's a lot of money pouring into these companies. Their valuations are very high, and, they're addressing massive market opportunities. And, I think that I don't think we've seen a period of so many of these different industries being disrupted all at once like we are right now.
Yeah, I would agree with that. It's pretty exciting time. Pretty exciting time to be a founder. And I imagine the point of view from the VC is probably different. There's a lot of opportunities, but there's also a lot of competition for the best opportunities. It seems like if you've got the right pedigree and the right business model at the right moment in time, you can really dictate your terms. Taking off the liquid stock hat and putting back on the Archer, the VC hat, what are the types of opportunities and what are the types of founders that you are looking for?
Yeah, that's a great question. I am very founder and entrepreneur focused. I believe a great entrepreneur can, even if they maybe don't have the best product or maybe don't even start off with the best market, figure out a way to do it. And so I always back entrepreneurs first. And sometimes their first idea isn't the right one, but a great entrepreneur is like a great captain. They navigate the ship and they figure out how to get into the better waters. And so, with that as my compass, it has served me very well. I've certainly met people that had what I thought were great ideas and, we're getting into interesting markets. But, if you don't feel it, and I find, venture capital in particular, more than later stage investing, is a very physiological experience where you can feel your blood pumping when someone pitches an idea to you. And it's not about the idea, it's about them. It's about their ability to sell. It's about their ability to resonate. There's a real special quality. It's why Elon Musk is successful at everything he does. He's just a special person. And his ideas aren't always great, but he gets there eventually. And it's why you see certain entrepreneurs just continuing to do it over and over again. And so I always back the entrepreneur first. And obviously now what I'm doing is I'm a little bit later stage. So the entrepreneur has obviously proven themselves in many cases when it comes to a liquid stock investment. So then I am definitely focused a little bit more on where they sit in the marketplace, the current product, the current financing of the business. But still, the leader of the company is by far the most important element of any successful business.
Yeah, I tend to agree with that. Early in my career, I remember thinking that, I forgot what it was. It came up through maybe like people talking about the pay gap between the CEO and the workers. And I remember thinking a company is just a collection of individuals. It's just a collection of people. And, a good leader, yeah, you can kind of focus things a little bit one way or the other, but it's it's entirely overrated. And the further I got in my career and the more I saw how much not only does strategically the CEO set the decision, but also culturally and also, really, like you said, the captain navigating the waters, all the pivots and everything. My view on it really changed, and I agree. It's really, it's the CEO and it's the management that really have an impact. I'd say, most of the impact on how companies tend to go, at least the ones that I've been involved in from the inside.
And my best observation is that A's beget A's, meaning A entrepreneurs hire A quality people, and B's beget C's. And so obviously the CEO or the entrepreneur doesn't do everything, and so they need to build a great team around them, and of course and it's important that they obviously spread the wealth and make sure that everyone's happy and working together. But it's amazing how the best quality people want to work with the best entrepreneur and the best CEO. And you can just see it. I mean, when I make an investment in a company, I teach a class at UCLA and I get asked often, how do you know when things aren't going well? And the first sign that I see is you start to see the quality of people that A, are attracted to the company, and B, that the CEO, knows to hire. And the moment you start to see a degradation of quality, especially it's so important in startup companies where everybody matters and the contribution is so important for every person in the team. The moment I see the quality not where I would expect it to be, that's when I know things aren't going to work out well. And that's when I know I've made a bad decision with backing that initial entrepreneur. And that's always the telltale sign. And so, that's why you look at the success of companies like Apple and Amazon. And obviously it starts with Steve Jobs and Jeff Bezos and Bill Gates at Microsoft. But, just look at the quality of people that they've hired and retained. And, I mean, it's obvious as to why those companies are successful.
Greg, I like to close with this question, which is, tell me an obstacle that you faced either in your personal life or your career that you either found a workaround or just persisted straight through.
Yeah, so I was a partner at a firm called Redpoint Ventures for many years, a very venerable Silicon Valley firm, lots of assets under management, just a great group of guys, and I still have great relationships with Redpoint. I left Redpoint in 2010 after 11 years there to start Archer Venture Capital. And a lot of it was just because of my own entrepreneurial need to kind of start my own thing. I wasn't the founder of Redpoint. I learned a lot there. It was a great platform for what I'm doing now, but it was very daunting. When you leave a very successful, secure, safe place to work, excellent reputation, marketing machine, deals kind of just come to you. It was a very easy, life. And leaving it to start Archer, when I still had a young family and my wife to support, it was daunting. And I was now, having to start a new firm with no guaranteed income. I had to raise capital. I had to build a team, build the infrastructure, build a brand. It was definitely scary. And, it kind of came down to three things, I think. And, I'm sure this is common amongst all entrepreneurs. I think the first is just self-belief. You have to believe in yourself. You have to have confidence and optimism, or else you're just not going to make it through the hard times. Obviously, hard work. You have to be willing to do, what it takes, whatever it takes, making phone calls, hustling, meeting everyone you need to do, every task. And usually startup companies, you don't have a big infrastructure of people to do things. And so you have to be willing to do, a lot of the grease work as well as the glory work. And then probably, another important one is just perseverance. Just fighting through the challenges, never giving up. You get knocked down a lot when you start a firm. You often don't have a safety net. So you got to get right back up. You got to stay the course. And it kind of comes back to the first one. You just got to keep believing in yourself and in your judgment. And, it's been 10 years since then. I've now raised, Liquid Stock, which was a new fund and unknown. And we had to go and sell our vision to the world. And fortunately, things have worked out. But I feel like if you can kind of stick with those three things, self-belief, hard work, and perseverance, you can get through a lot in life, and hopefully, with a little bit of luck, you can succeed in just about anything that you do.
Well, that's amazing. That's great advice, and easier said than done. But you yourself have walked the walk and lived it. So congratulations to you on your success, Greg. Where can people learn more about Liquid Stock?
Yeah, thanks for asking. So we have a website, www.liquidstock.com, where you can read about us, contact us, reach out to us, and we will respond to you very quickly. Please follow us on our LinkedIn site, Liquid Stock on LinkedIn, and we also have a Facebook page. We'd love to have you follow us there. And any of those outlets are great ways to follow us, read about what we do, and connect with us. And so we look forward to connecting with folks at private technology companies who we can help solve with our many solutions.
Well, thank you for coming on the show tonight. Thank you to the audience for your time and attention. Please subscribe, share, rate, review, all that good stuff. And we'll be back on next week or the week after, or possibly the week after that. Thanks, and take care.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.